Hello everyone, today we are going to talk about investment, the capital market and the wealth of nations. First, we discuss why people invest. Before we make this discussion, we need to understand the types of capital. We have physical capital, equipments, and we have human capital, education, training, and experience. Investment refers to purchase or development of a capital resource. Savings refers to income not spent on current consumption. There is a connection between investment and saving. Savings is income minus consumption. So when you think about saving, let's assume income is Y. Consumption plus saving represents the income. So saving is actually unconsumed income. Investment is the use of this unconsumed income to produce capital resources. This saving becomes a resource for people who wants to do investment. Saving is required for investment. Someone must save in order to free resources for investment. So people usually prefer to consume today rather than in the future. Consumption in the future is valued less than consumption now because people have a positive rate of time preference. They prefer to consume goods and services sooner rather than later. But saving represents unused income. That means decrease in consumption will increase saving. And we know that this saving can be used for investment. Therefore, there is a trade-off here. In order to make more investment, you need to reduce consumption today, and by consuming less today, savings, which are the resources available for investment, will be freed. So for that reason, it's possible that sometimes we reduce consumption today in order to increase saving, increase investment, and by investment we know that the future consumption is going to be higher. Interest rates. The interest rate is the price of earlier availability of goods and services. So we say that people prefer to consume today. This is positive time preference of consumption. And we know that investment can increase if people give up consuming today. So how we can convince people not to consume today, that means they save more, so that we can have resources available for investment. That is called interest rate. Interest rate is the price of earlier availability of goods and services. So people who are in need of funds to do investment prefer to get the resources today. And they prefer to get the resources today, therefore they need to pay some compensation. That is called interest rate. Interest rate is the premium that borrowers must pay lenders in order to acquire purchasing power now rather than later. These funds may be used for either consumption or investment. The next question is how we determine the interest rates. Interest rates are determined by the supply and demand for loanable funds. Let's understand this loanable funds market. There is the demand for loanable funds and there is the supply for loanable funds. The demand for loanable funds comes from productivity of capital resources, investment demand. So most of the firms need for loanable funds because they may want to expand their factory or production. Or entrepreneurs, small businesses, all are in need of funds because they want to start their business or they want to expand their business. This is called investment demand. And the second reason for demand for loanable funds is the positive rate of time preference, consumers' desire for earlier availability. Interest rewards lenders who curtail current consumption, which is the supply of loanable funds, so others can buy now rather than later. The market interest rate brings the quantity of funds demanded by borrowers into balance with the quantity of supplied by lenders. Let's see this figure. The demand for loanable funds stems from consumers' desire for earlier availability and the productivity of capital. So this is investment demand plus consumers' desire for earlier availability. Positive rate of time preference. As the interest rates rises, current goods become more expensive in comparison with future goods. Therefore, borrowers will demand fewer loanable funds. When the interest rates gets higher, people demand less money, borrow less money. I hope that makes sense because cost of borrowing is increasing with the interest rate. On the other hand, higher interest rate is a reward. Higher rates stimulate lenders to supply additional funds to the market. In equilibrium, the quantity of loanable funds demanded equals the quantity supplied, and here this equilibrium represents, the price represents the equilibrium interest rate. So we have two types of interest rate, money rate and real rate. During inflation, nominal interest rate, which is the money interest rate, is a misleading indicator of the true cost of borrowing. Therefore, the money interest rate will include an inflationary premium reflecting the expected rate of inflation. So if the expected rate of inflation for the next year 10% and the premium that is paid for the availability of consumption of the funds 2%, then the money interest rate should be 12%. The 10% is because you want to keep the purchasing power of the lender constant. The real interest rate, which we call it R, is money interest rate minus the inflation. So real interest rate is a far better measure of the true cost of borrowing. There are more than one interest rates exist in the loanable funds market, and probably you hear most of them: mortgage rate, credit card rate, short-term loan rate, all are different. So the next question is why these interest rates are different. Interest rates have three components, which we will learn in the next slide. But we should know that if the risk increases, the interest rate increases as well. Riskier loans will have higher interest rates. Why? Because now we have the default risk. That means the borrower is not going to pay you back the principal, the initial amount. And also long-term loans are generally riskier. Why? Because in the long run, too many things can happen. So let's see the three components of money interest rates. Risk premium here reflects the probability of default, and this is large when the probability of borrower default is substantial. Inflationary premium reflects expectations that loan will be paid back with dollars of less purchasing power, and this is large when decision makers expect a high rate of inflation during the period in which the loan is outstanding. And the last component is the pure interest rate. It's the price of earlier availability of the funds for consumption or for investment demand. Next, we talk about the present value of future income and costs. The interest rate connects the value of dollars today, let's say today is t is equal to 0, with the value of dollars in the future. Let's say 1 year later, t is equal to 1. The present value of a single payment to be received 1 year from now on is the amount you receive here divided by 1 plus the interest rate. That is the present value of this future amount. And we call this discounting the future value. By dividing 1 plus interest rate is called discounting. Let's do one example. Let's say at t is equal to 1, you receive $100 and you want to know how much you need to deposit to the bank so that you receive $100 at the interest rate of 6% after 1 year. How do we find? We need to find the present value of $100. 100 divided by 1 plus the interest rate 6%. We are not writing here 6. We write here 0.06%. And then we find the present value $94.34. So if you deposit $94.34 today, a year later your money is going to be $100. So $100 is the future value, $94.34 is the present value. The present value of a single payment to be received n years from now on is the following formula. Let's say t is equal to 0, this time t is equal to 10. So let's say you receive $100 after 10 years. How you can find the present value of this $100? You take the future value, divide by 1 plus the interest rate is in decimal form, to the power n. Here n represents the number of years, which is 10. Here on the slide you see an example of interest rate 6% and n is 2. So you divide 100 by 1 plus 0.06 to the power 2, and that is $89. So the present value of a future payment is inversely related to interest rate. Here we use the 6% interest rate, but instead if we use 2% interest rate and want to find the present value of $100 received 1 year from today, it's going to be $98. So as you see, with 2% the present value is $98, with 6% it's $94. And when the interest rate is higher, present value is lower. And the second one is how far in the future the payment will be received. If the payment is going to receive after a year, present value will be higher. If it's received after 10 years, the present value will be lower, and so on. The present value of a stream of payments to be received each year for n years is this formula. So what does that mean? Let's say you receive $100 after 1 year, and then you receive another $100 after 2 years. So it's a stream of future payments. And t is equal to 3. After 3 years, you again receive $100 and so on. So how do we find the present value? We are going to discount each amount received in the future individually and then sum them up, all present values. In the first year, you receive $100 discounted by 1 plus 0.06, and that is $94. And second year, you receive another $100. This time you need to discount with 1.06 to the power 2, and that is equal to 89. And now after 3 years you receive $100 too. When you discount that, it is 83. When you sum them up, all these present values, you find out the present value of stream of payments. You see a table on the screen. The columns indicate the present value of 100 to be received n years in the future at different interest rates. So the first is 2%, 6%, then 12, then 20. And as you see, the present value is going down when the interest rates are increasing. And also, when you keep the interest rate constant, the present value is going down when the number of periods are increasing. The next topic we talk about today is present value, profitability, and investment. Now here, in this section of the course, we learn how to make a decision on an investment project. So we are going to make a decision on whether to undertake the investment project or not. You remember when we make decision in economics, we compare benefits and costs. For an investment project, benefits are in the future, costs are today. So we can't make a comparison between apple and orange. Benefits are in the future, costs are present value. We need to first find out the present value of future benefits, and then we need to compare present value of benefits with the costs that we pay today. You see one example here. Suppose a truck rental firm is considering the purchase of $100,000 of truck. They need to pay the money today. And experience dictates that the firm can rent out the truck for net revenues of $30,000 per year for 4 years. And the truck has an expected life of 4 years. It then has a zero value. As the firm can borrow and lend the funds at an interest rate of 8%, we discount the future expected income at 8%. And what is the present value of future benefits in that case? We need to discount individually all these payments, right? Here, 30K divided by 1 plus 0.8 to the power 1, which is 27,782. Here, 30K divided by 1 plus 0.08 to the power 2. This time it's 25,710. And on the third year, 30K divided by 1 plus 0.08 to the power 3, and that's 23. And finally, 30K divided by 1 plus 0.08 to the power 4, and that's 2250. And when you sum them up, all the present value of future streams, you get a present value of benefit of 99,360. Because the present value of the future income stream is less than the cost of taking the project should not be undertaken. So now we know how to make decision whether to undertake a project or not. We compare the present value of future benefits and the cost of undertaking the project, and if benefits are higher than the cost, you take the project, otherwise you don't. What if you take the project and you want to know the value of the asset or value of the project? How you can do that? The current value of an asset is determined by the present value of its expected future net earnings. And usually we assume that this asset is going to bring unlimited future earnings. So therefore we are going to use the perpetuity formula. So let's say this asset brings $1,000 of return every year and the interest rate is 10%. Divided by the interest rate I, which is 0.1. 10,000 is the value of the project. Okay, this is how we calculate the value. And I'm repeating here again, this 1,000 is the annual net return from the project, and we assume that this annual net return is going to continue forever. So we use the perpetuity formula. Perpetuity formula is value divided by the interest rate. If we assume the interest rate is 10%, the value of the project is 10,000. An increase in the expected future earnings, if this increases, then earnings derived from an asset will increase market value of the asset. So instead of 1,000, if this asset brings $2,000 every year with the same interest rate, the value of the market value of the asset jumps to 20,000. And if the interest rate is higher, the value goes down. If the interest rate is lower, the value is going to go up. The next topic we talk about is investing in human capital. And all of you are investing in human capital because you are taking this course. Consider the human capital investment decision facing Juanita, an 18-year-old who just finished high school. Here you see on the graph Juanita's expected earnings both with and without college. So without college is the blue line, with college is the red line. Juanita should decide whether to attend the college or not. If Juanita chooses to attend the college, she will incur both direct cost of a college, which is the cost of education, tuition and books, CD, and the opportunity cost of earnings foregone while in college, which is C0. These are based on earnings of unskilled person. And as you see, earnings with college is the red one. Now, how we are going to make a decision? We need to compare benefit and the cost. With the college education though, Juanita can expect higher future earnings during her career, that represented by area B. Even though they may begin lower, they end higher. If the discounted present value of this additional earnings, you see this is the additional earning. Why? Because this is the earning without college, this is the earning with college, the difference is the additional earning. If the discounted present value of this additional future earnings exceeds the discounted value of direct and indirect cost of the college education, then the college degree will be a profitable investment for Juanita. So we have the cost here, we need to find a present value of this cost, and we have the future benefits, we need to find a present value of future benefits and make the decision to attend the college or not. The next topic is we are going to talk about uncertainty, entrepreneurship and profit. Economic profit plays a central role in the allocation of capital and the determination of which investment project will be undertaken. In a competitive environment, profit reflects two things: uncertainty and entrepreneurship. So when there is risk, the rewards are higher. And entrepreneurship represents the ability to recognize and undertake profitable projects that have gone unnoticed by others. So if you think that you have entrepreneurship mind and you realize that a business is not managed good, therefore the value of the business could be increased by remanaging, reorganizing. As an entrepreneur, you can buy that business at a cheap price and then make the necessary changes and sell it at a higher price. So you can make a profit. In an uncertainty, you also can make a profit because risk is not something people like to deal with it. If there is a risk, most of the people scares to invest. Okay? But when there is uncertainty, the rewards can be higher. Let's look at income shares of human and physical capital. Employee compensation, which are the wages, right? And self-employment income primarily represent returns to human capital. These two components represent approximately 80% of total national income in the US for several decades. Note that the share going to physical capital rose to 22% during 2011 and 2012, while the share of human capital fell to 78%. At this point, it's uncertain whether this recent larger earnings share of physical capital is a temporary fluctuation or reflective of a long-term trend. If the potential gains from innovative ideas and human ingenuity are going to be fully realized, it must be relatively easy for individuals to try their innovative and potentially ingenious ideas, but difficult to continue if the idea is a bad one. To grow and prosper, a nation must have a mechanism that attracts savings and channels it into investment projects that create wealth. The capital market performs this function in a market economy. So investors need funds, and the capital markets are channeling this people's saving to the people who needs them. When property rights are defined and securely enforced, productive investments will also be profitable. Without a capital market, there is no mechanism that can be counted to consistently channel resources into wealth-creating projects. And the next topic is, how about the government? When investment funds are allocated by government rather than the market, an entirely different set of incentives comes into play. Political influence rather than market returns will decide which projects will be undertaken. So that means the funds are going to go to the projects maybe that are not economically efficient. Businesses will use contributions, lobbying, and other resources to attract favors from the government. Instead of businesses are using funds to expand factories, to expand production, or to invest into a good idea, they are going to use these contributions for lobbying. In turn, politicians use subsidies, tax breaks, and bailouts to help those most willing to provide them with political support. Profits and losses direct investors toward productive projects and away from those that are counterproductive. The political process does not have anything similar to profit and loss that can be counted on to direct funds toward wealth creation. As a result, the political process will lead to the inefficient allocation of capital. So this is the end of chapter 27. Thank you.